Beijing, October 2025. In the sterile conference rooms of the People's Bank of China, central bank officials stare at a number on their screens: $700 billion. I've watched treasury markets for 2 decades. I've never seen central bankers this quiet. That number represents U.S. Treasury debt China still holds. Bonds, IOUs from the world's largest economy. Securities that, for decades, represented the safest investment on Earth. The kind of assets pension funds bought and forgot about. The kind that anchored the entire global financial system. These aren't just pieces of paper. This is 700 billion reasons why China has stayed quiet during trade disputes. 700 billion threads connecting 2 superpowers in an economic web so intricate that pulling on one strand could unravel everything. But here's what they don't tell you in economics textbooks. China has been selling, not gradually, not politely. In the past year alone, China dumped over $50 billion of U.S. government bonds. Japan sold even more. Month after month, the world's largest creditors are backing away from American debt. The financial press mentions it in footnotes. Central banks issue bland statements. But nobody wants to say what everyone knows. But there's a problem nobody wants to discuss. What happens if China doesn't just trim its holdings? What if tomorrow morning Beijing wakes up and decides it's done? What if they sell everything? $700 billion of bonds flooding the market in days, not years. You might think this is impossible. After all, wouldn't China hurt itself? Wouldn't this be financial suicide? Like burning down your debtor's house while you're still owed money? The answer is more complicated than Wall Street wants you to believe, and the implications reach far beyond stock tickers and interest rates. This could reshape global power itself. To understand why this moment terrifies central bankers and keeps Treasury secretaries awake at night, we need to understand how 2 former enemies became each other's banker and debtor, how America built an empire on borrowed money, and how that empire now rests on the goodwill of a rival who may no longer be willing to lend. Talk to any bond trader off the record, and you'll hear the same word: unprecedented. This is the story of the most dangerous financial weapon never used. Until now. The relationship between China and U.S. debt didn't start with hostility. It started with necessity. After the 2008 financial crisis, America needed to borrow trillions to save its economy. Banks collapsed, markets froze, Bear Stearns vanished over a weekend. Lehman Brothers filed the largest bankruptcy in history. The Federal Reserve cut rates to 0, but it wasn't enough. The U.S. Treasury had to issue bonds at an unprecedented scale. Someone had to buy them. China stepped up. Not out of charity. China was running massive trade surpluses with America, selling consumer goods and accumulating dollars. Every iPhone shipped to Los Angeles, every toy sold at Walmart, every piece of furniture bought on Amazon, all paid in dollars. Those dollars had to go somewhere. U.S. Treasury bonds offered safety, liquidity, and a place to park over $1 trillion by 2013. For years, this arrangement worked beautifully. America got cheap loans to finance its lifestyle. China got stable returns and kept its currency competitive, so exports stayed cheap. It was the financial equivalent of a drug dealer giving his best customer credit. Mutually beneficial, until the customer gets too dependent. But by 2025, the music has stopped. China's holdings have fallen from a peak of $1.3 trillion to around $700 billion today. The reasons are complex. Trade wars that turned personal. Fears of sanctions after watching what happened to Russia. A desire for financial independence. The slow realization that holding someone's debt doesn't make you powerful. It makes you invested in their survival. The key players in this drama are straightforward. The U.S. Treasury, which issues about $5 trillion in new debt annually just to refinance old bonds and cover budget deficits. the Federal Reserve, which buys bonds to control interest rates and can print unlimited dollars. Foreign central banks, especially China and Japan, who together held over $2 trillion in U.S. debt at peak. And financial markets, where Treasury bonds serve as the foundation for everything from mortgages to corporate loans to the $5 trillion repo market. What's at stake? Nothing less than the architecture of global finance. U.S. Treasury bonds are called risk-free assets. They're the collateral backing trillions in daily transactions. They're the bedrock of pension funds, insurance companies, and banking systems worldwide. When Treasury bonds become risky, when their prices crash and yields spike, the entire financial system trembles. But there was a problem nobody anticipated back in the 2000s. America's creditors were also its geopolitical rivals. And unlike Britain's relationship with America in the 1940s, where shared values created trust, the U.S.-China relationship rests on fragile mutual benefit. The moment that benefit evaporates, the calculus changes. To understand how this pressure cooker was built, how America became addicted to foreign debt, and why China holds the valve that could release decades of accumulated tension, we must examine three escalating rounds of decisions that brought us to this precipice. America's debt addiction didn't happen overnight. It was the result of choices that seemed rational at the time. In the 1980s, America discovered something extraordinary. The world wanted dollars more than America wanted foreign goods. After World War II, the dollar became the global reserve currency. Oil traded in dollars, international debts settled in dollars. Every central bank needed dollar reserves. This created what economists call exorbitant privilege. America could borrow cheaply because the world had to lend to it. It was not exploitation. It was the natural result of winning World War II and building the institutions that governed global finance. The logic seemed bulletproof. If you control the global reserve currency, you can run trade deficits indefinitely. You can borrow to consume today and repay with cheaper dollars tomorrow. You can finance wars, social programs, and tax cuts without immediate consequences. For decades, this worked. By the 2000s, America was running annual trade deficits exceeding $700 billion. That meant $700 billion flowing out every year to buy imports, electronics from Asia, oil from the Middle East, manufactured goods from China. Those dollars came back as purchases of Treasury bonds. China, selling manufactured goods to American consumers, accumulated mountains of dollars. They recycled those dollars into U.S. government bonds. At its peak in 2013, China held $1.3 trillion in treasuries. This arrangement suited both sides. America got cheap imports and cheap loans. Mortgage rates stayed low at 4%. The stock market boomed. Middle-class families bought bigger houses and newer cars. China got export-led growth, employing hundreds of millions in factories, making goods for American consumers. Chinese leaders accumulated dollar reserves as insurance against future crises, remembering the Asian financial crisis of 1997, when countries without reserves were devastated. The trap was set, but nobody saw it. But there was a problem hidden beneath the surface. This system required endless trust. China had to believe America would always repay its debts. America had to believe China would always buy its bonds. Both had to believe the dollar would remain the world's currency forever. The moment any of these beliefs cracked, the whole structure risked collapse. And by 2018, cracks were appearing. President Trump launched a trade war, imposing tariffs on $250 billion worth of Chinese goods. China retaliated with tariffs on American soybeans, cars, and aircraft. But the tensions escalated beyond economics. Technology restrictions, military maneuvers in the South China Sea, competition for global influence. American politicians from both parties began talking about decoupling from China. For the first time, Chinese officials started asking uncomfortable questions. What if America freezes Chinese assets during a crisis like it did to Russia after Ukraine in 2022? What if the dollar-based financial system becomes a weapon instead of neutral infrastructure? What if holding U.S. debt makes China vulnerable rather than secure? These weren't paranoid fantasies. They were rational calculations based on observed behavior. By early 2025, China had reduced its treasury holdings to $700 billion, down nearly 50% from peak levels. Some of this was mechanical. China's trade surplus with the U.S. had shrunk as manufacturing moved to Vietnam and India, so fewer dollars flowed in. But some was strategic. China was diversifying into gold, buying over 300 tons annually, converting reserves into euros and yen, building alternative financial infrastructure, including their own international payment system to bypass the dollar-dominated SWIFT network. America barely noticed. Treasury auctions still found buyers. Interest rates remained manageable at around 4% for 10-year bonds. The Federal Reserve's balance sheet, bloated from post-2008 quantitative easing, provided a backstop. Stock markets hit record highs. Nobody panicked. But the dependency had deepened. By 2025, U.S. federal debt had surged past $35 trillion. The annual interest payment on this debt approached $900 billion, more than the defense budget minus war costs. The U.S. Treasury was issuing $5 trillion new bonds annually, not for new spending, but just to refinance maturing debt and cover deficits. Foreign investors who once bought 35% of this debt were now more skeptical. The trap was complete. America needed foreign buyers. China was losing interest in being that buyer, and the tools that worked in past crises, Fed intervention, dollar dominance, market confidence, rested on the very trust that was eroding. What nobody understood yet was how fragile the system had become. In March 2020, during the COVID panic, the Treasury market, supposedly the most liquid market in the world, broke. Prices swung wildly. Dealers couldn't intermediate. Investors holding risk-free bonds couldn't sell them at any price. The Federal Reserve had to buy hundreds of billions in bonds in days just to keep the market functioning. If a temporary pandemic panic could break the Treasury market, what would a deliberate, sustained selling campaign by the world's second-largest economy do? That question was about to be tested in ways that would terrify policymakers worldwide. The trigger came not from Beijing, but from Washington. In April 2025, a new wave of tariffs was announced, 500% on certain Chinese electric vehicles and solar panels, framed as economic defense against unfair subsidies. But tariffs alone weren't the issue. The issue was the accompanying rhetoric. American officials began floating ideas of restricting Chinese investment in U.S. assets, talk of screening foreign treasury purchases, suggestions that foreign holders of U.S. debt could be subject to new oversight or even sanctions if tensions escalated. One senator introduced a bill requiring strategic adversaries to register their treasury holdings publicly. For Chinese officials, this crossed a line. If America could restrict who buys its debt, then holding U.S. Treasury bonds wasn't safe. It was a liability. Bonds that could be frozen, seized, or subjected to political interference weren't risk-free assets. They were hostages. But China faced its own trap. Dumping $700 billion in bonds wasn't simple. If China sold bonds quickly, prices would crash and yields would spike. That would mean immediate losses on the bonds China still held. If they sold $100 billion and the market dropped 10%, they'd lose $60 billion on their remaining $600 billion. It would also strengthen the dollar in the short term as foreign exchange markets adjusted, making Chinese exports more expensive and hurting China's economy. Economists call this mutually assured financial discomfort. Wall Street's version of a Mexican standoff. China couldn't destroy America without hurting itself. But by summer 2025, Beijing's calculus was changing. Chinese policymakers began to see their treasury holdings not as an asset generating returns, but as leverage that was losing value anyway. Trade tensions weren't improving. Sanctions threats were escalating. The strategic competition was intensifying. Better to use the leverage while it still had impact than hold it until it became worthless. Internal Communist Party documents, later leaked to financial press, revealed discussions about strategic de-dollarization and the weaponization of financial interdependence. The conclusion was clear: financial ties were becoming strategic vulnerabilities. In August 2025, China began selling more aggressively. Not everything at once, that would cause immediate panic and destroy their own positions. Instead, $50 billion per month, steady and deliberate. They sold through multiple channels to avoid detection, some through primary dealers in New York, some through offshore accounts in Luxembourg and Ireland, some through sovereign wealth funds that technically weren't the central bank. The impact was subtle at first. 10-year Treasury yields, which had been around 4%, ticked up to 4.3%, then 4.5%. Market analysts attributed this to inflation concerns or Federal Reserve policy normalization. Nobody wanted to say the obvious: a major creditor was withdrawing. But by September, the pattern became unmistakable. Data released by the U.S. Treasury Department showed China's holdings had dropped to $700 billion in August, then $688 billion in September, then $675 billion in October. Other foreign central banks were also pulling back. Japan, facing its own economic pressures and a collapsing yen, reduced holdings by $40 billion. Middle Eastern oil exporters diversifying into non-dollar assets as BRICS nations pushed alternative currencies, sold bonds. Foreign holdings that had peaked at over $8 trillion were now declining month after month. Instead of confronting the problem, policymakers tried to manage perceptions. The Federal Reserve issued reassuring statements about orderly market conditions. Treasury Department briefings emphasized that domestic demand was strong. Primary dealers, big banks like J.P. Morgan and Goldman Sachs, were required to bid at every auction and stepped up purchases. The Fed quietly restarted quantitative easing, buying $80 billion per month in Treasury bonds to fill the gap left by foreign sellers. But markets are smarter than press releases. By October 2025, 10-year yields hit 5%. Mortgage rates, which track Treasury yields plus a spread, jumped above 7%. Housing markets froze overnight. Home buyers couldn't afford monthly payments. Construction companies halted projects. Developers canceled plans. Regional banks holding mortgage-backed securities and long-term treasuries saw the value of their portfolios decline, eerily reminiscent of Silicon Valley Bank's 2023 collapse. When bond prices fall, banks show losses. When losses mount, depositors get nervous. Corporate borrowing costs soared. Companies planning expansions canceled projects. Layoffs began in interest rate-sensitive sectors like real estate, construction, and automotive. The stock market, which had been resilient, started dropping as investors realized higher rates meant lower valuations for growth companies. The Federal Reserve faced an impossible choice. They could buy more bonds to suppress rates, but that would fuel inflation and risk the dollar's credibility. They could let rates rise, but that would trigger a recession and banking crisis. They tried to walk a middle path, buying some bonds, but not too many, raising short-term rates to fight inflation while trying to keep long-term rates stable. Nobody believed they could thread this needle. Growing tension rippled through global finance. The repo market, where $5 trillion in daily transactions occur using Treasury bonds as collateral, began showing stress. Dealers demanded higher haircuts, meaning they lent less money against the same collateral. Funding costs spiked. Overnight rates jumped from 5% to 7%, then briefly touched 10% during the moments of panic. Some hedge funds using Treasury bonds as collateral for leveraged positions faced margin calls, and had to liquidate positions. This created selling pressure that fed on itself. More selling meant lower prices. Lower prices meant more margin calls. More margin calls meant more selling. What policymakers didn't realize was that this escalation wasn't just economic. It was geopolitical. China wasn't just selling bonds for profit or safety. They were sending a message. America's exorbitant privilege rested on China's willingness to participate. Take that away, and the whole system shook. And if America threatened to restrict Chinese purchases, China would prove they didn't need to buy at all. By November 2025, the question was no longer whether China could dump bonds. The question was whether America could survive, if they did. December 2025 brought the crisis to its breaking point. Markets open in Hong Kong, then Singapore, then London, then New York. On December 3rd, the People's Bank of China issued a statement that would be remembered as the financial equivalent of a nuclear test. The PBOC publicly stated it would rebalance reserves away from dollar-denominated assets over the coming year to enhance financial security. No specific numbers, no timeline, just intent. Markets understood immediately. This wasn't about $50 billion per month anymore. This was about $700 billion total, possibly more if you counted state-owned banks and sovereign wealth funds with unofficial holdings. 10-year Treasury yields exploded. Within a week, they hit 6%, then 6.5%. The spike was unprecedented in modern history, a full 2.5 percentage points in a matter of weeks. Bond prices, which move inverse to yields, collapsed. Every pension fund, insurance company, and bank holding treasuries saw massive losses appear on their books. The Federal Reserve held an emergency meeting. Chair Jerome Powell faced the nightmare scenario every central banker fears. Buy bonds aggressively to stabilize markets, risking inflation and dollar credibility. Or let markets clear naturally, risking financial Armageddon. They chose intervention. The Fed announced unlimited bond purchases, essentially promising to buy whatever the market wouldn't. In the first week alone, they purchased $300 billion in treasuries. The balance sheet, which policymakers had spent years trying to shrink from its COVID peak, exploded back over $9 trillion, and that's when everything changed. When a central bank prints money to finance government debt directly, it's called monetary financing, a polite term for what Weimar Germany did in the 1920s, what Zimbabwe did in the 2000s, what Venezuela did before its currency became worthless. The consequences are always the same: inflation, currency collapse, economic chaos. Markets recognized this immediately. The dollar began falling against other currencies. The euro, which had been worth $1.10, jumped to $1.25. The Japanese yen, which had been weak at 150 per dollar, strengthened to 130. Gold prices soared from $2,000 per ounce to $2,800. Bitcoin, that digital escape hatch from government money, hit new all-time highs above $120,000. Inflation, which had been tamed at around 3%, began rising again. Import prices surged as the dollar weakened. Gas prices jumped from $3.50 per gallon to over $5. Food prices followed: milk, bread, meat, all climbing. Within 3 months, headline inflation hit 6%, then 7%. The real economy cratered. With mortgage rates above 8%, home sales dropped 40% year over year. Housing prices, unable to sustain at high rates, began falling in major markets. Homeowners who had bought at the 2024 peak found themselves underwater, owing more than their houses were worth. Foreclosures ticked up for the first time since 2012. Small and regional banks faced catastrophic losses. They had loaded up on long-term treasury bonds when rates were 2 to 3%, expecting stable returns. Now those bonds had lost 20–30% of their value. depositors watching news of bank losses and remembering Silicon Valley Bank's 2023 collapse began withdrawing funds. Bank runs started in smaller institutions in February 2026, then spread. Lines formed outside branches. Online banking systems crashed from traffic. The FDIC had to intervene, guaranteeing deposits and arranging emergency mergers. By March, 17 regional banks had failed or been absorbed by larger institutions. Corporate America went into survival mode. Companies canceled investment plans, froze hiring, initiated layoffs. The unemployment rate, which had been 4.1%, rose to 6% by March, then 8% by May. Consumers, spooked by job losses and falling home prices, slashed spending. Retail sales plummeted, restaurants emptied, discretionary purchases evaporated. The crisis spread globally through interconnected financial markets. European banks holding U.S. assets faced losses. Japanese pension funds saw their treasury portfolios crater. Emerging markets, which borrowed in dollars, faced twin crises as dollar funding dried up and their currencies collapsed against a now volatile dollar. Turkey's lira lost 40% of its value in weeks. Argentina defaulted on its debt for the 10th time in its history. Pakistan, Egypt, and Bangladesh requested IMF bailouts. The geopolitical implications were even more profound. China's move demonstrated that financial power could rival military power. They hadn't fired a shot, launched a missile, or invaded a neighbor. But they'd shaken the global system to its foundations. Other countries took note. Russia, already distanced from dollar markets due to sanctions, accelerated alternative payment systems. Middle Eastern oil exporters began pricing some contracts in yuan and euros. The dollar's 80-year dominance as the undisputed reserve currency began eroding in real time. Saudi Arabia, America's partner since 1945, signed a currency swap agreement with China. American policymakers faced a menu of terrible options: cut spending drastically, triggering deeper recession; raise taxes in a downturn, political suicide; implement financial repression, forcing domestic institutions to buy bonds, distorting capital allocation; print money to finance deficits, risking hyperinflation; or, unthinkably, restructure the debt, destroying America's creditworthiness for generations. The tragic irony was inescapable. America had built its empire on debt. That debt required willing lenders. When the largest lender decided the risks outweighed the rewards, the empire trembled. The tools of dominance, the most powerful military in history, technological leadership, cultural influence, meant nothing if you couldn't borrow money to sustain them. Britain learned this lesson in 1945. America was learning it in 2025. By early 2026, the question wasn't whether America would recover. The question was what kind of America would emerge. One with diminished global influence. One where living standards declined as debts came due. One where the exorbitant privilege was revealed to be a dependency that rivals could exploit. China hadn't destroyed America. They'd simply stopped subsidizing it, and nobody saw it coming. The immediate aftermath reshaped the global order in ways historians are still documenting. Within 6 months, the dollar's share of global reserves fell from 60% to under 50% for the first time since 1945. The euro, Chinese renminbi, and even gold gained shares. International trade began diversifying payment currencies. Oil contracts appeared denominated in yuan for Chinese buyers, euros for European buyers. The BRICS nations, Brazil, Russia, India, China, South Africa, accelerated plans for alternative financial infrastructure, launching a development bank rivaling the World Bank. America didn't collapse, but it adjusted painfully. The federal government, facing $1.2 trillion in annual interest payments, implemented austerity measures unthinkable a year earlier. Defense spending was cut by 15%, forcing base closures in Europe and Asia. Social programs faced reductions, Medicaid funding cut, food stamp eligibility tightened. Infrastructure projects were canceled. The political backlash led to the rise of candidates promising economic nationalism and isolation. The banking sector consolidated dramatically. Dozens of regional banks failed or were absorbed into giants like J.P. Morgan, Bank of America, and Wells Fargo. The concentration of financial power increased, creating institutions even more too big to fail than before. The financial system became simultaneously more fragile and more politically protected. For ordinary Americans, the crisis meant a decade of diminished expectations. Unemployment peaked at 10.2% before slowly declining. Wages stagnated as companies prioritized debt repayment over expansion. Housing, once seen as guaranteed wealth building, became a burden for many who bought at peak prices. Retirement accounts, heavy with bond holdings, were devastated. A generation approaching retirement faced the prospect of working years longer than planned. The long-term consequences extended beyond economics. America's ability to project power globally diminished. Military operations required financing. Without cheap borrowing, choices had to be made. Bases were closed in Germany, Japan, and South Korea. Alliances were questioned. Commitments wavered. Rivals sensed opportunity. The unipolar moment that followed the Cold War was definitively over. But there's a deeper pattern here that history teaches us. Financial power eventually determines geopolitical power. Spain's empire collapsed when Andean silver mines depleted and debts to Italian bankers mounted in the 1600s. Britain's empire ended when World War II debts made it dependent on American loans. In 1945, Britain owed America roughly 50% of its GDP in war debts. Within 5 years, the empire was dismantled. Bases closed. Colonies granted independence. India, jewel of the empire, became independent in 1947. The Suez Crisis of 1956 proved Britain couldn't act without American financial approval. The debt didn't destroy Britain militarily. Britain still had nuclear weapons, a professional military, centuries of diplomatic experience. The debt destroyed Britain's ability to afford being a superpower. Today, America's situation echoes this. Not identical, but the pattern rhymes. The country with debt loses options. The country holding debt gains leverage. And the transition is never smooth or welcomed by the declining power. This isn't conspiracy. This is math. And math doesn't care about narratives. This teaches us that economic power, like military power, requires constant renewal. The empires that endure are those that produce more than they consume, innovate faster than rivals, and maintain the trust of their creditors. The empires that fall are those that believe their advantages are permanent, their debts costless, and their dominance unchallengeable. We see this pattern playing out today in real time. China's economy faces its own challenges: real estate bubbles, demographic decline, authoritarian brittleness that stifles innovation. But their move against U.S. debt demonstrated that they understood financial interdependence is a two-edged sword. The country that seems dependent might actually be the one with leverage. The world we're entering is more multipolar, more fragmented, and more unstable. No single currency dominates completely. No single country dictates terms unilaterally. Power is diffused among blocs and regions. For those who grew up in the post-1990 era of American financial hegemony, this feels chaotic. For much of the world, it feels like a return to historical normalcy. The question now isn't whether this transition happens. We're living through it. The question is whether this transition proceeds through managed adjustment or repeated crises. The answer will define the next quarter century. And understanding this history isn't just academic. It's survival. Because the next time a major creditor decides to pull back, whether it's Japan facing demographic collapse, or Middle Eastern exporters moving beyond oil, or European nations dealing with their own crises, we'll know exactly what happens. The script has been written. The The patterns are clear. And the consequences are no longer theoretical. This is the hidden history. Subscribe now, because when the history books are written about this decade, you'll want to be among the few who saw it coming. Not after the collapse, but before. Not when everyone knew, but when it still mattered.